Chris McAlpin, the managing partner at Sound Financial, and this is our August client update. So welcome. I'm glad you're here. I hope you're enjoying the dog days of summer. It's hot out there. It's hot everywhere. It's hot in the markets, and they are roaring up or down. Just kind of pick your day as to which way it's hot, but it's certainly steamy. And in these updates, we are talking to our clients. We're talking to our family. We're talking to our friends. So this is us talking to us. And the purpose of these are for educational purposes. They're not to give investment advice. And that's my ho-hum, boring but true disclaimer. But it is to tell you how we see what's going on in the world and how we're responding in your investments, especially those of you that have trusted us with your investments. And what we're going to do for the rest of the year, August through December, in the middle of the month, we're going to have virtual meetings. I want to have some Zoom calls, and you're going to be invited. And it's going to be a similar presentation to what we're doing right here. But I want you to be able to stop me and ask questions and hear our response real time and be able to hear your concerns and say, okay, this is what we want to do to respond to your concerns, because we appreciate the trust that you put into us when you have hired us to help you with your financial plans, to help you with your investment accounts. Those financial plans, and we're going to talk a lot about investments today, but I said this at the first of the year, your financial plans, your financial goals are super valuable to us, and we want to make sure that you're staying within reach of those goals. We want to make sure that you're still moving forward to those goals, even in a year just like this, okay? And so let's dive in, because certainly this year has been a little, shall I say, chaotic and stormy, right? You saw this screen at the first of the year. Does 2022 feel a little bit stormy? Well, yes, it did then. It still does now. And we're going to probably see more storms this year, certainly more market storms. And we're going to respond based on our rules, based on our math formulas, based on those that we have tested against history. And so you're going to see more trades. Please don't be alarmed by those. We're just responding to what's going on in the world. And two top topics continue to be the biggest part of what's going on in the world. Now, granted, there's a war in Europe. Granted, there's a midterm election. Granted, there is more fodder for the headline news to just be pounding us with the negative news and the bad outcomes of all the days of everything that's going on in the day. But when it comes to the investment space, we still believe the top two topics are inflation and rising interest rates. And as I said, you've already experienced the inflation. I've said this a couple of updates ago. When you go to the gas pump, when you go to the grocery store, you're paying higher prices than you've paid in 40 years relative to the price that it was last year. That's inflation, that year-over-year increase in prices. Okay. Now we have rising interest rates. We talked back in January that the stock market was trying to price in 4, 5, 6, maybe at most 8 interest rate increases this year, and those would have been quarter-point increases. The market missed it big time. Okay. The market said it's going to increase. The Fed's going to increase 7 to 8. So 1 3/4 to 2% increase this year. Well, they're already at 2 1/4 to 2.5%, and they're probably going to 3. The Federal Reserve is determined to kill inflation. Now, they're going to do the best they can to not kill the economy, but it's probably too late for that, because what we believe we're seeing with the leading economic indicators is that the economy is already in contraction, and the Fed still needs to raise interest rates. That's not a good mix. But we also believe that we're seeing kind of two stories going on between stocks and bonds. The stock market is trying to wave the all clear flag and is trying to bounce and recover, whereas the bond market is still saying we're headed into a recession, we're headed into a recession, we're headed into a recession, and the Fed's going to have to lower interest rates next year. The Fed's going to lower interest rates next year. Now, if the stock market is trying to price that in, that the Fed's going to lower interest rates next year, and they're trying to get a jump on it today, that is terribly optimistic, to the Pollyannic kind of stage of stocks, because there's probably some choppy waters we got to go through between now and then. But you know what? I can't predict the future. But the best thing that we can do is look in the past and see how our rules will have held up to the past. So I asked myself, are there any markets in the past that we can look at that might help us determine what could happen today? And I believe that answer is yes. So let's get through. That's my cute little slide for today there. 3 phases of the market: buy, sell, and panic. We have not seen the panic sell yet. We might avoid it. I kind of don't think we will, but we might. So, but let's look at what's happened this year, okay? Let's see that coming into this year, the market sold off. Let me get a better highlighter here. The market sold off through June, losing 24%. Now, I'm using the S&P 500. We don't buy or sell. We don't trade the S&P 500. And I'm not recommending that you do or you don't. I'm just using this as a proxy. I'm using this as an example. What we saw is that the market sold off about 24% through this period of time in July. And what we've seen since then is that the markets have grown back nearly 13%. Well, in fact, a little bit over this in the last weeks to month. Over the month of July, we saw a big, gigantic bounce in the S&P 500. Now, when I compare to history, I wonder, have I seen this before? Is this the turnaround? Is this the beginnings of a bull market? Or is this a bear market bounce? Or is this a bear trap? And I've said this many times, but you can actually see this live in a color. This is what happens in the future on the right side of the chart. I don't know what happens next. And so we need something that helps us make decisions. But for now, let's look in the past, okay? Let's go back to the year 2008. And we see that in the year 2008, that the markets also sold off to the summer. It lost 18% in the year 2008 to midsummer. It then got a bounce there, not quite as big as ours this summer, but we got about a 9% bounce. It's about a 9.25% bounce that summer before selling off that nasty September, October, November of 08 sell-off, where that market before the end of the year went negative 38.5%, and that market overall went negative 55. So buying into this bear market right there, that was nothing but a bear trap. Okay, let's look at another year, the year 2000. We see something similar. So the market peaked here in around March of 2000, immediately sold off into April and May and lost 14%. It rebounded throughout the summer, almost waving a big giant all clear flag, growing almost all of that 14% back before losing around 20% through the end of the year, before that market sold off 50% overall into the October of 2002. That's the the tech bubble, or the tech wreck, as that's often known. So if we see those 2 years where there's a sell-off, a bear trap bounce, and then a nasty sell-off, we now can look at our year with a little bit of a different lens. So this one sells off, we get the growth. We don't know what happens next. Is this a bull trap? Is this a bear trap, or is this the beginnings of a bull market? I don't know. But let's look at one other indicator. This is the U.S. Treasury bond yield curve. Now, what you see right now is the Federal Reserve, when it pushes interest rates up, it affects this end of the curve. As they raise interest rates, they're pushing this end up. What that does is that takes money out of the economy in the short term, okay? But as this end of the curve, the long end of the curve, starts to go down, okay, that is telling us that there's more risk on the short end than in the long end. That starts to be predictive, historically predictive of recessions. And when you'll hear the news talk about the twos and the tens. It is the 2-year Treasury and the 10-year Treasury. When the 2-year is higher than the 10, that historically predicts a recession almost every single time. And especially when you get back here, the 6 and the 10. The 6 is higher than the 10. And it is very much predicted that the 3 is going to go above the 10. Okay. And when that happens, it is highly likely that we're going to get a recession. Now, how do stocks typically respond in recessions? Well, they typically go down because it starts to squeeze the earnings of those companies that are in those stock indexes. Okay. But we don't know that. We can't predict that. Although we can look into history, we can see that's typically the response. Often the stock market sells off before the economy actually goes into the recession. Now, I'll tell you one other thing that this is predicting for us, okay? That this end of the yield curve, this long end of the yield curve, as it goes down, okay, as this moves down, I'm going to get another color so that you can see it better. As this moves down, this is the yield. The prices are going to go up of these bonds. We want to be holding these positions in your portfolio. We believe that this pivot has started and this would be a good investment through the end of the year. Only time will tell. Again, we can't predict the future, but I do like how this is looking for us. Let's look at an indicator on stocks, okay? We like to use the 10-month moving average. What this tells us is over the previous 10 months, what is the daily average price of this particular index, okay? And as this index has moved down underneath this average, we have taken conservative steps here on February 1st, here in late April, here in late May. We've also did it in late June. Now, one thing that has happened is as this has grown back here at this point, we actually added some stocks at this point. This actually answers a couple of questions for us, okay? How do we know when to get out of the way of stocks? How do we measure that? When it comes to stocks, we use the 10-month moving average. So as a stock moves, as an individual stock moves beneath this average, we'll sell that stock, okay? As an individual stock moves above this average, like right here, we'll buy it back, okay? And we do this once a month. And so you're going to see a few more trades here at the end of July, probably see a few more at the end of August, the end of September, and so forth. Okay, because I get this question from clients a lot. Well, how do we know when to get out? And are we going to get back in? And will I miss the upturn? Will I miss the rebound? I can't promise you we're going to be perfect. In fact, I can promise you we're not going to be perfect. This is not a perfect signal, and a perfect signal does not exist. But I believe it's a very good one, and there's reams of historical data that show that this is a good signal to be able to get out of the way of falling stocks and get back in when those stocks recover. Now, when I was preparing for this presentation, I had a lot of slides, and I'm going to do that. I'm going to show a lot of slides that demonstrate what I'm talking about in our virtual meetings over August and September and October and so forth. But I didn't think we should do it this time. I want to be able to allow you to ask questions and be able to see what we're talking about. And I don't want to nerd out too much, but I want to demonstrate that we want to look at the facts of what's going on. We want to look at data that we can measure and make a response to. And that is the most important thing that we're going to do. We want to control what we can control. We want to avoid large losses. And we did that by selling stocks as they were falling beneath the 10-month moving average. We did that by selling out of a lot of bonds earlier in the year and getting out of the way of a lot of those that are falling. Now, we want to invest in winners as well. And we believe that the bond market has pivoted and is entering a growth cycle. So most of our clients' models are in up to 70% U.S. Treasury bonds and cash. Okay. And we have added a few stocks that just recently have moved above the 10-month SMA, which is a simple moving average. That's the signal that we use. And so as we avoid large losses, we invest in winners, I believe that we can navigate this market very well. So if stocks turn out to be right and a bull market has started, by golly, we're going to jump on that train and we're going to ride it, hopefully ride it for a very long period of time. But if bonds are right and we're in a recession, and there's some nastiness coming for the stock market before that recession ends, then hey, we're going to pivot to bonds, and we're going to stay over there safe, relatively safe and secure in bonds, and let them do their thing for us as well. Overall, I want us to manage our emotions. And I know that this is easier said than done. And I also know that we can have peace in the ebbs and the flows of markets. I mean, gosh, I've talked about this all through the summer, that even the Bible talks about 7-year business cycles and 50-year debt cycles that was written back 3,000 years ago. Of course, it's God's word, so it has a tendency to be really right. It has a lot more than a tendency to be right there, you know. And so we want to move wisely in these ebbs and flows. We want to have peace in them. We want to be confident in the decisions that we're making, and also extremely confident in just being honest and transparent. We can't predict the future. We know that we can't. That's why we want to use math formulas and signals to make our decisions. And so we appreciate the trust that you put in us. We're working hard to serve you. We want to do it with excellence. If you have any questions, call your advisor or call me. Again, I'm Chris McAlpin at Sound Financial. We are happy to serve you. We're glad to serve you. So thank you. Take care. God bless.